Good morning, ladies and gentlemen. It is my pleasure to be able to welcome you to the Czech National Bank's meeting with analysts after more than a year in person again. And since it's the last meeting of the year, in line with the tradition, it is hosted by Czech National Bank Governor Jiří Rusnok. Other speakers are Executive Director of the Monetary Department Petr Král and Director of the Macroeconomic Forecasting Division Karel Musil. As you all know, the Bank Board yesterday raised its two-week repurchase rate by 1.25 percentage points to 2.75%. This decision was based on a new forecast, which will be now presented to you by Petr Král. Petr, you have the floor.
Thank you for the floor. Good morning, ladies and gentlemen, dear colleagues. It is really my great pleasure to be here in persona after a quite long period of time of having only online meetings with you. I am here to deliver a presentation on the CNB's new quarterly macroeconomic forecast, which served as a basic input into yesterday's monetary policy decision of the board. Let me start by highlighting the structure of my presentation. First, I will outline the assumptions based on which the new forecast was prepared. Then I will go into the detail of the story of the plot of the new forecast, including its quantitative dimension. After that, I will provide you with a brief comparison of the new forecast with the previous one. And final part of my presentation will be devoted to scenarios and monetary policy simulations we prepared to illustrate the current heightened uncertainty and monetary policy relevant discussions. After lifting the anti-pandemic measures in the euro area, which are the countries of our major trading partners, the economic growth accelerated and continued over spring and summer this year. However, industrial production in the world, including euro area and the Czech Republic, was disrupted by the overloading of global production and value chains, which will, according to the assumptions of our forecast, abate only in mid-2022. Overall, GDP growth in the euro area will reach 3.4% this year and accelerate further in the next year. The current overloaded global chains and increasing energy prices are materializing or manifesting themselves into the steep rise in producer price inflation, which is about to culminate in the next couple of months. And subsequently, we can expect some deceleration of PPI growth in the effective euro area. The crude oil price has been rising quite sharply in recent months, and we can expect a culmination of crude oil price only at the beginning of next year, and then gradual decline of this price thereafter. Energy prices, together with high industrial producer prices, are spilling over into the consumer price inflation in the euro area, but the European Central Bank is taking quite, let's say, wait and see stance or position, and the markets expect only very modest or tentative increase in 3-month Euribor rate in the second half of the forecast horizon, and the expected tapering of the ECB's quantitative easing programs are manifesting themselves in the expected profile of the shadow rate, which is an important part of our external side assumptions. Let me now turn your attention in more detail to the observed and expected high growth in producer price segment. Those pressures are being driven by both energy and core component, with the energy component playing now roughly the same role as the core component. The energy component has been reflecting the strong price increases of energies on commodity exchange, namely electricity and natural gas. And after stabilizing those high prices, we can expect relatively quick price correction, which will lead to the deceleration of PPI growth in both Q-on-Q and year-on-year terms. In the same direction, the gradual easing of the current problems with the overloaded value chains will also have a positive effect, but it will take some time to be fully visible in the data. The high world commodity and energy prices are spilling over into the domestic regulated prices via the standard channels. Until now, the domestic regulated price growth was very subdued, being close to zero, but this will change relatively rapidly and relatively significantly in the coming months. There will be a specific period of 2 remaining months of this year when the waiver on the VAT will be affecting regulated price growth. As you probably know, the Czech government decided to put a waiver on the VAT on electricity and natural gas for households, which will turn those prices to decline in absolute terms and to push the regulated price growth as a whole into a negative territory for these specific 2 months. But after this measure expires, we can expect, following the previous sharp increases of energy prices on commodity exchange, and the regulated price growth will accelerate to reach more than 9 or 10% at the very beginning of the next year, and this will be relatively stagnant or relatively persistent price pressure factor or inflation factor through the rest of the next year, and only following the stagnation or the correction of the world commodity and energy prices, we can expect relatively strong and abrupt deceleration of regulated price growth as from beginning of 2023. The other important domestic assumption or parameter of the whole forecast is the fiscal policy. As for the government consumption as such, which is a particular demand side item of the GDP, we can expect deceleration of its growth this year, which is primarily the effect of the previous very high base from the last year, and this deceleration should continue even for 2022 and to some extent for 2023. The nominal government consumption is driven by continued growth in non-wage component of it, which is this year reflecting the extraordinary expenditures on vaccination and testing related or being manifesting itself in healthcare spending. And besides that, there is also wage component, which is growing also relatively fast this year, and only some relatively mild deceleration can be expected for the years to come. As to the fiscal support in total, looking at the fiscal impulse, we can expect that after last year's very significant positive contribution to fiscal policy to GDP growth of approximately 1.5%, this year the fiscal stimulation is still present, but is somewhat less pronounced compared to the previous year, making a contribution of approximately 0.6 percentage point to GDP dynamics. These measures are this support is driven by measures affecting primarily household disposable income and household consumption. And besides those targeted measures that were introduced to compensate for COVID measures like several job retention schemes, etc. There are also some non-COVID related measures such as increase in social benefit, etc. that are causing the expansionary fiscal policy stance to continue this year. Next year, after the targeted anti-COVID measures expire, we can expect negative fiscal impulse of approximately 0.5%, despite continuing increase in old age pensions going beyond the standard indexation scheme, and despite some other increasing expenditures, including government investment, which are benefiting from the continuous drawdown of the EU money. For 2023, the forecast assumes a neutral fiscal policy stance or fiscal impulse, as the forecast is based on the already approved measures, not on the plans of possible future governments. I will spend some part of my presentation discussing the possible results or implications of some hypothetical fiscal consolidation taking place as from 2023. The final part of the assumptions is related to the pandemic situation. As you know, the daily figures of newly confirmed cases are increasing these weeks and days in the Czech Republic, but the situation is somewhat better compared to the last year, despite there might be some time shift only in the data. But the vaccination of the whole population, and especially vaccination of the sensitive people, is protecting the society against massive spread out of severe cases and against the overloading hospitals. That's why we expect that the potential anti-pandemic measures to be taken by the government or by other authorities will have only will be targeted on those specific groups or specific type of activities, and will not have any material negative impact on the economic development. Let me now turn your attention to the new forecast as such. I will start with the most important variable, which is inflation. According to the new forecast, inflation will accelerate further in the coming months and will reach almost 7% over the coming winter. The increase in inflation will be driven practically by all major items, including core inflation segment, food price inflation, and as from the beginning of next year, also by the regulated price growth. Inflation will gradually, correct or stabilize during next year and will be declining relatively sharply back to the upper boundary of our tolerance band at the end of next year and to the vicinity of our 2% target on the monetary policy horizon, which is the turn of 2022 and 2023. Monetary policy relevant inflation will be only marginally below the headline inflation almost on the whole forecast horizon due to the expected increases in indirect taxation on tobacco. I was already saying that the expected increase in inflation will be driven by almost all components. Here you can see it in the upper chart. The core inflation, which has been the primary driver of the domestic consumer price growth until now, will accelerate further, reflecting the accelerating or increasing contributions of imputed rents to this segment. But the spike in inflation, which can be expected in the first quarter of next year, will be promoted or supported by the already mentioned acceleration in regulated price growth and by further increase in food price growth, which will be closely related to the world agricultural commodities increases. We can expect that the fuel prices growth, which has been quite significant in previous quarters, will continue for some time before it declines somewhat following the correction of the crude oil price or stabilization of the crude oil price. The imputed rent contribution to the core inflation is very closely related to the observed longer-term price growth in residential property prices or housing prices and to the fast-growing construction inputs, which is partly related to the world energy and other commodities prices and partly related to the domestic demand situation and the mortgage market situation, which has been going through a booming period for a quite long period of time. We are quite frequently asked which part or what part of the observed inflation profile can be attributed to the domestic demand side factor and what part or which part can be attributed to the external supply side or cost push factors. We did a specific or special analysis during our macroeconomic forecast exercise, which is to you available via a box in our monetary policy report. In this box or in this analysis, we try to correlate the basic segments within the CPI basket with the domestic demand side situation and domestic labor market situation, which is approximated by our standardly used LUCI index, Labor Utilization Composite Index. Following the results of our analysis, we can claim that the most rapidly growing parts of the core of the consumer, the most rapidly growing prices within the consumer basket are those who are very closely correlated with the LUCI index, and that's why we can estimate that the share of domestic demand environment in the market service prices is very high, reaching almost 70%, the relatively big proportion of demand-side factors is also to be identified within goods inflation and food inflation, making in total that approximately half of the observed CPI growth can be attributed to the domestic inflation, domestic demand side and labor market situation. If we use these results of our analyses and if we compute the so-called supercycle inflation by reweighting the standard weights within the consumer basket and if we adjust the weights by the strength of the correlation of individual segments with the Lucy index, we end up with this super cycle inflation, which is the red line in the bottom chart. And as you can see, this line had been above the headline inflation for quite a long period of time, beginning somewhere in 2017 or 2018, and currently the spike of this supercycle inflation is even sharper than the headline inflation. As for the standard decomposition of inflationary factors within our forecast, we have this type of picture. The total growth in marginal costs in the consumer sector will accelerate further in the coming quarters, and this will then decelerate back to approximately 2%. The correction of this trend will be driven primarily by the renewal of the negative contributions of both core import and energy import prices, following the foreign assumptions or the assumptions regarding world economy, as I was discussing at the very beginning of my presentation. This change to the anti-inflationary mode stemming from these import prices will be promoted in its effect on domestic prices by the expected appreciation of the koruna against the euro. As for the domestic costs growth, we can expect further acceleration in the quarters to come, being driven primarily by the acceleration of fundamental wage, which will be promoted by the increase of the minimum wage by 1,300 crowns, which is almost 9% effective as from the beginning of next year. The labor efficiency will, after some short-term volatility, somewhat curb the domestic inflation pressures by contributing in a standard way, as one would expect from those productivity gains. The labor market has cooled down only marginally during the COVID period, and it started to get even more overheated in the previous months, and it will continue to do so in the quarters to come. We can expect that the employment will turn to positive year-on-year figures, and the unemployment rate will continue to decline, despite the space for further decline of the unemployment rate is relatively limited, as the Czech Republic has the lowest unemployment rate among the EU member states. We can also expect some acceleration of the fundamental wage growth in the business sector, with the specific contribution of the minimum wage increase, which I was already mentioning. This acceleration of nominal wage growth in business sector will be driven by heightened inflation, which will somewhat spill over into the wage contracts, and by the fact that there will be only a relatively very limited spillover of the current problems in the domestic industrial sector, as we expect that this episode will be relatively short-lived. Wage growth in non-business sector will grow at a slower pace compared to the previous years, as there will be as there were some one-off factors affecting that before, and those are not present in the future. As for the GDP growth, we expect that the Czech economy, after having seen relatively swift economic growth over spring and summer, will somewhat decline in the fourth quarter of this year, following the problems of and disruptions of the functioning of the global value chains, to which the domestic small, open, export and industry-oriented economy is relatively highly sensitive. That's why we expect that the fourth quarter of this year will be relatively very weak and will be negatively affected by the declining industrial production. But the sources of economic growth on the demand side are relatively strong and robust, and will continue to drive the GDP growth for the years to come, with the household consumption and especially fixed investment being the major contributor to the ongoing economic growth. In sum, this year we can expect approximately 2% GDP increase, and the GDP growth will accelerate to more than 3% in next year, and to almost 4% in 2023. Following these expected figures, we can expect that the economy will reach its pre-COVID economic level by the end of next year. The economy, following the robustly growing domestic demand and facing the disruptions on the supply side, is currently breaching the level of its potential, and is expected to operate somewhat above the potential over the next couple of quarters. So the positive output gap will be really opening, and there will be some only a marginal or gradual decline in the positive output gap further in the longer horizon. I was already mentioning that household consumption will continue to generate a positive contribution to GDP growth. The household income of the domestic households will continue to grow in nominal terms, benefiting from all the standard items such as wages and salaries, social benefits, and other sources. But the relatively high nominal growth will be confronted with increased, very high and increasing inflation, which will to some extent erode the purchasing power of the nominal revenues of household sector. But the consumption will be supported by pent-up demand, or by the spending of the forced savings which the household had to generate during the lockdowns of the economy in the previous waves of pandemic. This deferred consumption will make some positive effect on the overall profile of the household consumption for the rest of this year and at the beginning of next year. The fixed investment growth has been quite significant in recent quarters and will accelerate further, being driven by both corporate and government sector. As I was already mentioning, the government sector will try to spend as much money as possible from the current EU programming period and will start to draw down money from the New Generation EU facilities or these type of programs. The private sector or corporate sector will invest to adjust to the situation where there is very scarce and very expensive labor force. So the automation and machinery and other equipment investment will try to compensate for this unavailable labor force. The gross capital formation as such will be relatively volatile due to the contribution of changes in inventories, as those are currently reflecting the fact that industrial sector could not, due to the shortage of several components, could not finalize a big part of its production, and this unfinished production is forced to be got into the changes in inventories. This factor will gradually evaporate as we expect normalization of the situation on this front in the coming quarters, and after that there will be some specific period of finalization of the unfinished production and export of it to the foreign markets, which will simultaneously promote the export performance of the country. The above-mentioned situation is very nicely seen in the expected profile of both export and import sides. The export performance has been relatively very subdued during this year, and we can expect that there will be some correction of that or some reacceleration of export growth in the next 2 years after those current problems in global value chains disappear. And the import side is traditionally very closely related to the export profile, but it has some specific driver in the form of domestic demand, which will be growing quite fast. That's why there will be some deviation from dynamics of exports from that of import, and that's why the net export will generate persistently negative contribution to GDP growth in the quarters to come. As for the exchange rate forecast, we start with the initial assumption that the exchange rate of the koruna against the euro will be on average at 25 koruna per euro for the fourth quarter of this year, and there will be some further appreciation of the currency in the years in the quarters to come. The appreciation will be driven primarily by the widening of the interest rate differential of the koruna against the euro, promoted later by the fading problems on the export and industrial side of our economy. An expected modest future tightening of the ECB's monetary policy will have a relatively marginal effect in the opposite direction. That's why the exchange rate appreciation will continue, and we will get close to 24 korunas per euro at the end of 2023. Consistent with the new macroeconomic forecast is a sharp rise in market interest rates at the end of this year and at the beginning of next year. The steep rise in interest rates is a reaction of the central bank to the combination of strong domestic and foreign inflation pressures. The initial steep rise in rates will limit the impact of the current inflation pressures on inflation in the longer-term perspective, and will ensure that inflation will return to the inflation target or to the vicinity of the inflation target on the monetary policy horizon, which is the turn of 2022 and 2023. The bold monetary policy reaction is also contributing to the anchoring of inflation expectations of Czech firms and households. During 2022, after the return of inflation back to target is started, the domestic interest rates could to decline somewhat to approximately 3% policy neutral rate, as this is consistent with the future fulfillment of the inflation target and with the expected still very, very accommodative monetary policy stance of the ECB. If we look at the on the interest rate profile using the real interest rate perspective, we can expect that in the quarters to come, the sharp nominal interest rate increases will only compensate the expected acceleration of inflation, and only after there is decline of inflation back to the upper boundary of the tolerance band and further to the 2% target, there will be some material increase in real interest rate from below to zero and slightly above zero at the very end of the current forecast horizon. Let me now compare the new forecast with the previous one. As for the foreign assumptions, we have shifted this year's GDP growth in the euro area downwards, following the most severe and lengthier problems on the global value chain side. The same factor has contributed to the shifting of producer price growth upwards, together with upward revision of the expected crude oil price. The shift of the whole foreign environment to a more pro-inflationary stance is being reflected in a relatively mild recalibration of the expected ECB's policy. And as you can see, the upward revision of the headline Euribor is relatively very mild. More pronounced is the shift of the expected tapering of the ECB from its current QE programs, which is reflected in this graph by the upward shift of the shadow rate profile. As for the domestic economy variables, the new forecast brings very strong upward revision of the CPI growth for the end of this year and for next year. This is the reflection of more pronounced inflation factors stemming from both domestic and foreign economies. The GDP growth forecast has shifted downwards for the coming quarters and for the coming year, reflecting the more severe problems in the domestic industrial sector and domestic export-oriented production. The wage growth in market sector is expected to be somewhat higher compared to the previous forecast, and the expected appreciation of the Czech koruna, of the exchange rate of the Czech koruna towards the euro is somewhat stronger, or relatively significantly stronger compared to the previous forecast. This reflects primarily the more pronounced widening of the interest rate differential against the euro, which is very closely related to the change of the forecasted interest rate path. Here you can see that the interest rate forecast has been revised upwards very significantly for the several quarters to come. The primary driver of there is a quite long series of factors standing behind this upward shift. The initial conditions, which is the reflection of the past or the observed price growth in domestic and foreign economy, is the one factor. The other factor is the expected or the upward revision of the expected foreign PPI growth, which together with the new near-term outlook for domestic inflation and near-term outlook for exchange rate is also shifting the expected interest rate path upwards. The same is true for the regulated price growth, which is reflecting the higher than expected price increases of energies on commodity exchanges. The only factor which is in the short term somewhat curbing the upward revision of the interest rate path are the expert judgments, which reflect the longer-lasting problems in the Czech manufacturing and export-oriented sector. But after these problems fade away, there will be a contribution of this factor in the opposite side in the longer part of the forecast horizon. Also, the greater domestic labor market tightness is making a contribution to the upward revision, which is also embodied by these expert adjustment contributions. Let me conclude my presentation by introducing some other scenarios and simulations we prepared to illustrate the very heightened uncertainty which is surrounding the economic developments, and also to illustrate monetary policy considerations when we had to, when discussing with the board, the optimal monetary policy reaction in this at the time being. One of the major risks of the new forecast is the possible longer duration of the current problems in global value and supply chains, which in the baseline scenario are expected to expire or to fade away approximately in mid-2022. If this problem is longer lasting or broader based, we can expect that foreign economic activity will be negatively affected compared to the baseline, which will be primarily a reflection of a weaker economic potential or weaker supply side of foreign economies, which is nicely seen in the lower left chart by the deviation of the expected potential output in the euro area vis-à-vis the baseline. Simultaneously, these negative supply side factors will push the expected PPI growth in the euro area even higher compared to the baseline, which is generating some extra inflation factors, which in the assumptions of this scenario, the ECB will have to react. So in this scenario, after some quite short period of non-activity, the ECB reacts by increasing its interest rates and by closing its QE programs to combat the extra heightened inflation pressures. As you can see in these graphs, the domestic economy is suffering in this scenario by lower GDP growth, as the industrial sector is more negatively influenced compared to the baseline, together with higher foreign PPI growth, and together with the weakening of the currency following the worse export performance of the country, the domestic inflation is shifted upwards compared to the baseline, to which the domestic monetary authority reacts by hiking interest rates even stronger compared to the baseline scenario, which in turn prevents the nominal exchange rate from depreciating, and it ensures some stability of the exchange rate. This is influencing the domestic inflation pressures, which are bigger than in the baseline scenario, relatively significantly, but not dramatically. And after that, there is after this shock evaporates, in this scenario we converge back to the baseline plot. The other risk going in the opposite direction is the possible fiscal consolidation being put in place by a future government. This consolidation this scenario is describing a hypothetical situation in which some type of consolidation is introduced. This is not based on any specific plans or specific programs. This is just a what-if scenario we prepared to illustrate the sensitivity of domestic variables to possible fiscal tightening. So if we assume a fiscal tightening of 1% of a GDP in 2023, we would get to a more or less booming domestic demand and less pronounced overall GDP growth, especially in 2023, which is generating somewhat milder inflation pressures compared to the baseline. To which the domestic monetary policy reacts by somewhat lower nominal interest rates compared to baseline, and simultaneously the exchange rate is endogenously reacting to the new situation by being somewhat weaker compared to the baseline scenario. Final simulation is illustrating the fact that we are very careful about inflation expectations, and we very closely monitor any possible deviations of the inflation expectations from our 2% inflation target. In this scenario, we asked ourselves what happened if the monetary authority increases nominal interest rates slower compared to the baseline scenario. And if this happens, one can also ask what happens if the inflation expectations remain well anchored to the inflation target, or alternatively, what happens if inflation expectations diverge somewhat from the inflation target. So here you can see that if inflation expectations are firmly anchored close to 2%, and monetary authority is lagging behind with the necessary interest rate hikes, there is only a mild deviation of inflation from the baseline scenario. Whereas if there is deviation of inflation expectations from the 2% inflation target, specifically in this scenario, we expected that inflation expectations will, for a short period of time, increase to 3%. There is more pronounced deviation from the inflation from the target, and the monetary authority has to compensate its previous slower interest rate hikes by making big steps in the longer part of forecasting horizon. And as part of this monetary policy, slower reaction is expected by economic agents from the very beginning of this scenario. The exchange rate is appreciating somewhat more compared to baseline, as agents expect that the future interest rate hikes will be relatively very bold, which is in the forward-looking manner affecting the exchange rate. But at the end of the day, despite this final reaction of the interest rates and the initial exchange rate appreciation, the inflation is significantly above the baseline scenario and is gradually converging to the baseline only in 2023 or further, where the inflation expectations get back to the 2% inflation target of the central bank. Ladies and gentlemen, having said that, I would like to thank you for your attention for now, and I am passing the floor back to our spokesperson, Markéta Fischerová.
Thank you, Petr, for the comprehensive presentation. Now we can move on to the Q&As. May we have the first question, please? Helena Horská.
Thank you, Petr, for your presentation, and thank you for introducing some, would say, alternative scenario, especially fiscal policy reaction. I appreciate very well. Regarding the question, maybe it's on the governor directly. Please, could you confirm the planned attention to surprise the market, or would say the beat market expectation by your step did yesterday, and the reaction of the market has fulfilled your expectations, or you would expect some another reaction of the market? Thank you.
Okay, thank you. It was definitely not kind of, let's say, preferred intention or intention of the first row, we guess, considering the final decision to surprise. Yeah, that's something which we definitely take into account, that it will be the surprise for the market, but I wouldn't say it was intended as a target or as an aim to do it. That definitely what we as well discussed, and what I can admit, that we would like to express or send the signal, very strong signal to the market. So kind of demonstrative aspect in that is definitely as well. Regarding the fulfillment of our expectations, I wouldn't say we have specified expectations what will be the market reaction. We was rather, I would say, how to say it, we do not have kind of specific movement of the, if you mean probably mainly the exchange rate, what would be taking into account the recent experience with the corona and the general environment in the market of the emerging markets, I mean FX emerging markets, we do not have expected or kind of big expectations that there will be a kind of big shock or something like that in the market. I wouldn't say more to this. From my perspective, I am speaking personally because we do not discuss that at all. What could be the reaction of the market. From my perspective, I do not feel any disappointment what market reacted. I think it's more or less in the line what we can expect it, and we will see. I think it's too early to assess, so that's all.
Thank you. Another question, please. Okay. Jakub Seidler.
Hello, again, thank you very much for a great presentation. Maybe I would have two questions. Firstly, only to assume that you do not expect VAT reduction for 2022. It's only for end of 2021, right?
That's right.
Okay, thank you. And second question, maybe the part of the market is a little bit wondering whether the approach of the CNB towards FX reserves is not a little bit asymmetric. If you wanted to push inflation higher, you did not have trouble to intervene in a massive amount. And now we are facing definitely the situation when FX channel is somehow let's say broken and Corona is not appreciated as much as would be maybe reasonable to assume given the interest rate differential. So this question still remains why the CNB is so unwilling to use FX reserve to push a little bit Corona to stronger levels. I know the official statements that you want to focus more on traditional tool, which is interest rate, but still there might be potentially some economic arguments behind. For example, you are afraid that if you start, it will not be easy to end, or if there were some discussion about this basically tool, which seems to be a little bit intuitive after the FX floor regime from last years. Thank you very much.
I can only stick to the official statement we did many times in the past that the interest rates are the primary monetary policy tools we use actively to influence inflation on the monetary policy horizon. And simultaneously, our exchange rate regime could be described as a managed floating, so we deserve the right to intervene on the foreign exchange market if there is some extra exchange rate volatility or some disruptions in the functioning of the foreign exchange market to ensure the smooth functioning of the target of the market, or to ensure that the exchange rate will not damage the primary objective of the Czech National Bank. That's probably everything I can say from my side.
Okay. I maybe try to add something to this. What Peter said. In my, it was not at all the topic we have been discussed, at least yet. My perception of that is that. Situation is extreme, definitely, in some aspect, what we used to have it last 2 decades or something like that, or at least 15 years. Nevertheless, it's still not so extreme that we should pass away, I would say, the basic paradigm of our monetary policy, and this is really that we use as an instrument and main instrument interest rates. That's first. The second remark, If you look to the situation from the perspective of the level of interest rates, the situation is not so extreme. We are still at the level which is more or less normal, I would say, if we compare with the normal times. So I do not see also from this point of view any reason to broken this paradigm and to go your way or way you described. I can't exclude that something like that could happen in the future. I don't know. You never know what will happen. But at the moment, my opinion, my perception is that we are not at all at this point of development that we should think this way. Anyway, the FX reserves, this is, of course, it's a part of our monetary policy ammunition and equipment, definitely, but still I think it's much more linked, at least in my mind, with a very extreme situation on the market or something like that. So, and in this respect, we are still not at this. So maybe that's my comment.
Thank you. Who is next? Jan Vejmělek, Komerční banka.
Good morning to everybody. I have a question on guys from the Monetary Policy Department. Could you tell us more or provide us with more details regarding your assumptions on energy prices and VAT changes? Do you expect that the full drop in VAT will be translated into energy consumer prices, or do you expect kind of sticky prices? Thank you.
Basically, we expect full transmission of the waiver of the VAT into the final prices for consumers for November and December this year, but no further measures in the area of combating high energy prices for the next future. As for the energy prices, we standardly use the market outlook for crude oil price and natural gas price. Those markets are now very volatile. There is definitely an extra uncertainty regarding the spillover of the heightened and volatile prices into the final prices for domestic households, especially in times where some energy providers went belly up, and there is some uncertainty how the Czech Statistical Office will address those who had to change their providers, forcefully change their providers. So we can expect some non-standard regulated price development in the next couple of months, including October data, which will be published already on Wednesday next week. But for the further future, we expect relative swift return to normal situation, and domestic regulated price growth reflecting again quite closely the foreign energy price developments. I would like to ask Karel if he wanted to add something. No? That's all.
Thank you. Another question comes from Maidan.
Hello, thank you very much for your presentation today. I would like to ask two questions. So first of all, just to follow up the question from Jakub on the FX, in your current forecast by Q1 next year, you have Euro Czech coming down to 24.3. And we've seen the Czechs a bit of difficulty in appreciating. So if it doesn't reach that level, Would you say the rule of thumb on exchange rate and interest rate is the same as you used to have in terms of 1% in FX is 25 basis point in the interest rates? And if not, then what are the reasons that we should consider? The second question is about the auto sector. Right now, there's a lot of expectation that it is a temporary issue and it will fade in, in the middle of next year. What are the signs that you're looking for to see if it's a more problematic situation in auto, especially for the very auto-focused economy like the Czech Republic? Thank you.
As for the first question, I would like to remind you of the fact that traditionally in the past we were trying to attribute some specific story concerning the possible deviation of the exchange rate from the baseline scenario, or the story standing behind possible sensitivity scenario regarding the possible exchange rate deviation from the baseline. That's why if the exchange rate, and we are in the same situation now, the exchange rate had been moving relatively nicely in the previous parts of this year, following the renewed growth of the domestic economy, reopened economy, and quite nice performance of export, export performance. Since it appreciated shortly after the September hike by 75 basis points, but it depreciated somewhat, and it diverged from the assumptions of the new forecast, assuming 25 koruna per euro on average for the fourth quarter of this year. We need to ask what factors are standing behind this relative weakness of the currency, whether this is a pure negative sentiment regarding Central European countries which are now facing another wave of the coronavirus pandemic, or whether this is specifically related to the negative effects of malfunctioning of global value chains on domestic economy, which is, as I was already saying, very heavily exposed in the manufacturing and is very highly export-oriented, or whether this is a reflection of the fact that markets have shifted their expectations concerning the policy normalization of the Fed, which traditionally has an effect on emerging countries' currencies. So if we in the future see a deviation of the exchange rate from the baseline, we will have to make a story standing behind that. And that's why I'm not very keen on saying that the standard sensitivity scenario parameters will be used to assess the new situation. If there is such a risk, we will definitely prepare a targeted scenario describing the most likely factors explaining that deviation, and you will see this scenario in the next monetary policy reports, definitely. For the automotive sector and the signs we are concentrating on, I would like to ask Karel.
Well, we try to closely monitor the situation and check what is the implication of some disruptions in this sector, in this industry, and try to somehow consistently implement it into the forecast. Right now, we do not consider that the situation is significantly worsening or changing compared to the situation what we have in the baseline, so we do not consider some extra or additional risk that are coming from the recent development.
The Skoda car producer has started to operate again, effective as from Monday this week. The flash estimate for the GDP growth for the third quarter was somewhat better compared to our near-term forecast within this forecasting exercise, but the situation is unclear. That's why we do not expect so far major deviations from our forecast for the fourth quarter, for which we expect a relatively muted or subdued economic activity, especially being driven by the automotive sector and the cluster of its subcontractors.
Maybe add something to these ethics considerations. We are not worried of the FX rate. Of course, what we are doing is that we present forecast of the FX rate, and of course we present the assumption which we have in our forecast. And it's always so, and we always stress that it is not a commitment, it is not an, say, hard data which we should fulfill like a plan or something like that, but it's a part of our general consideration of the situation in the economy. And I wouldn't be worried if we will not target perfectly in specific quarter, which could happen always. I think first of all, it could be somehow corrected in the next quarter. That's first. And the second remark maybe, in case the exchange rate didn't appreciate as we expect in our forecast, it brings us also some other possibility to consider the next steps in our monetary policy decision making. So it's a part of the game, and we are taking in the account, and but we are definitely not fixed to this as a very exact number in very short period of time. So I wouldn't be worried of that.
Thank you. Yes, please go ahead. Just introduce yourself, please.
Hi, Martin Janíčko, MND. Thanks for the presentation. First of all, I have two general questions. The first one is about potential output. What is in your view, monetary policy rate which is consistent with the current potential output of the Czech Republic? If you can comment on that a bit more in detail. And the second question is about pent-up demand. As you are mentioning pent-up demand quite a lot as one of the sources of the recovery in 2022. My question is whether you do not underestimate the rise in energy prices in the pent-up demand, because in my understanding, the energy prices can harm the economy quite asymmetrically depending on the expenditures of individual households on energy. So in my understanding, I would assume that can play quite a role in 2022. Thank you.
I will start with the second question. We take fully on board the effects of the increased energy prices within the regulate price growth via private consumption deflator and its effect on household consumption as whole. And the pent-up demand is making a part of the story, not only in the Czech Republic, but also in some other countries, including Germany, including US, etc. And those factors are mixing together in this macroeconomic environment and in this new forecast with the still very negative real interest rate playing quite significant role. and also the, let's say, tolerance of the domestic households for price increases of certain goods and services in the Czech environment is still relatively high due to this forced savings and due to the very strong labor market. We still have to bear in mind that the Czech labor market is again overheating, that there is absolute severe shortage of available labor force, and nominal wages are still growing apace, which is non-comparable with any other Western countries. That's why we need to take this into account, together with the fact that based on the empirical analysis, the regulated price increases are having some effects on consumed volumes, bringing the total amount of money spent for energies being not very dramatically increased when we see price increases of energies, and that's why the amount of money to be spent on the rest of consumption goods and services is not very much negatively affected by those increased energy prices. What is also clear is that the factor of heightened price pressures in the economy will, to some extent, spill over into the wage negotiations for the next years. People will to see that their wage increases will compensate for the loss of the purchasing power of their current wages, and this is also a factor which we have incorporated into the forecast of nominal wages, real wages, and real consumption growth. Would you like to add something on this or on that, or shall we move to the potential output, potential level discussion? I'll start, and I will give the floor also to Karel. The potential of the Czech economy has definitely gone down compared to the pre-pandemic not only level but also to pre-pandemic trend, because the economy is not able to function as smoothly as it used to before the crisis. This is the first remark. The second remark is that the observed economic declines in previous quarters being driven by lockdowns or shutdowns of the domestic and foreign economies, together with the malfunctioning of the international international trade linkages, is attributed or attributable to the supply side rather than demand side factors. That's why we gradually re-estimated our assessment of the negative output gap to open or being opening during the previous COVID waves, and now we are very close to think that the negative output gap was opened relatively very mildly and to a relatively for a relatively short period of time. And after the economy reopened during spring this year, we are very fast approaching the potential output level, and we will be breaching it, and the positive output gap will increase for the several quarters to come. Is that answering your question?
Not 100%. My question was, like the second question was, what is the MP rate which is consistent with the current potential output?
The monetary policy rate is still the same. This is a part of our calibration of the steady state parameters of the G3 model, which is 3% potential output growth and 3% policy neutral rate as a sum of 1% real interest rate equilibrium and 2% inflation target.
Thank you.
Okay, Jakub Seidler again.
Thank you. If I remember correctly, before summer, CNB argumentation about the policy normalization was somehow conditioned also by pandemic development. But now I think that maybe there is some shift that despite the negative development of pandemic, it seems that this basically CNB plans to normalize rates will not change. So is it correct that basically now you assume that no matter what pandemic situation will look like, you are ready to further tighten monetary policy?
The situation is different despite the figures looks quite similar like the year ago. Basically the situation is different in epidemiology point of view because at least, I don't know, 60% of population is vaccinated. So the risk that the healthcare will be overloaded is significantly lower, at least what they are saying the experts. That's first. The second, we have much more experience as a society to live with the pandemic because this experience of the previous waves. So, despite still certain uncertainty of what could happen, we think and we think that the potential limitations or constraint or restrictions should be significantly lower, formally and also I would say in mind of people. People are definitely less afraid than were before. It seems to, at least me. That another argument I would maybe add is we have the switch of the government. The government which is going out is not more willing, I would say, actively act in this respect. They do not see the motivation, I would say, enough to do it. The new government is not still here, and from many perspectives, they were in past criticized the current government for doing too much. So now probably it's difficult for them to do it at all something. So there is a lot of constraint also from this political side, and this is also linked with the juridical problem, yeah? That the Czech system of administrative law is so complicated that it's almost impossible to impose some restriction which will be not finally cancelled by the courts. So if you put all of this together, it seems to me that our assessment of these, let's say, assumption is more or less realistic. Of course, we have still some uncertainty.
Maybe from the analytical perspective, the previous waves of pandemic were a stagflationary negative supply side shock rather than negative demand side shock, and those shocks were hitting economy, which was already very overheated before the COVID, and which needed to interest rates to normalize to address the inflation issues. That's why possible another wave of pandemic would probably have the similar effect on the inflation and inflation factors, and it wouldn't most likely not dramatically change the need to bring the monetary policy interest rates close to the policy neutral rate to ensure a medium-term price stability in this country.
Thank you. As we are running out of time, there is room for one more question only. Okay, Maidoan again.
Sorry, if nobody takes it, I will take this one. I would like to ask about the interest rate forecast in the new monetary policy report. We do see the 3-month PRIBOR going to 3.6 and then going down towards around 3 towards the end of the year and into next year. I'm just curious on the board's perspective, how do you see that? What's the feeling towards bringing rates high and then bringing it down later? Because I know that in the past, there's frequently a comment from the board saying that you want to kind of smooth the interest rate forecast from the research department. Thank you.
Yeah. That's, okay, you know, I will be probably not able to say something very, very strong about that. What we can see, it's a result of current forecast, which is somehow consistent with other assumptions. Of course, everything will depend on the development of the future situation. So, from my perspective, I can imagine once we will reach certain level which will be appropriate to the expected inflation forecast, we will stay at the moment definitely, and maybe for a longer time to see what will happen, what will be, you know, this is, it's of course, because it's far away from our today's perspective, it's very indicative. So I think we have been proved repeatedly that we can be quite flexible inflation targeters. So we will see what will the situation show us.
Thank you, and I will take an opportunity to raise the last question for today. It's on behalf of Oliver Weeks, an economist at the Brevin Howard, who couldn't participate today. And his question is, how should we understand the forecast path of 2.79% average policy rate this quarter? Given we were at 1.5% for the first month and the next meeting is in late December, does that imply the forecast assumed a much larger hike than 125 basis points in November?
The forecast is formulated for a 3-month PRIBOR rate, from which the 2-week repo rate is derived as in a relatively mechanical way, assuming the spread between the 2-week repo rate and 3-month PRIBOR. And the forecast does not take into account the institutional setup that the monetary policy meeting of the board is taking place roughly in the middle of the quarter. That's why we try to reformulate the interest rate path using our so-called interest rate sentence, which I was presenting a while ago, saying that the forecast expects or is consistent with the steep interest rate hikes in the end of this year and at the beginning of next year. And the monetary policy decision makers are knowing the trajectory of the PRIBOR and of the and know the possible combinations of how to reach the level if they want to follow the baseline scenario with no deviation from that based on their assessment of the inflation risks on other sides. And that's why the board
traditionally has some helicopter view on the mechanical on the exact interest rate path, and I wouldn't expect that the monetary policy decision for the rest of this year would somewhat dramatically let's say that the December monetary policy meeting decision would target the level of the prime rate for the first quarter of next year, rather than to mechanically follow the interest rate forecast for the last quarter of this year.
Thank you. Let me end this meeting by thanking to all our speakers, Governor Rusnok, Petr and Karel, and also to you for coming and participating in the debate. And since this is the last meeting of this year, in line with the tradition again, we would like to invite you to join us for a lunch and a chat in the bank club downstairs. There will be an opportunity to meet also other members of the board. And since we are going to meet only in February of last year, let me wish you a good rest of the year and Merry Christmas. Goodbye.